Everybody, Dave here, Hidden Freedom, and welcome back to another video. In today's video, we're going to go through all of the YLD's taxes for 2021. So that means QYLD, RYLD, XYLD, and we'll look at my actual taxes as well to kind of go through that and get an idea of how they were taxed in 2021. I know it's upset a lot of people, including me. And we'll also talk about, what should people do with these YLDs going forward, because this could really hurt some people. And they really need to know about this because there's a lot of information out there that's either wrong or the Global X is wrong, right? So I also did a video on taxes for JEPI and Devo. And you can take a look at that on the top right over here. I'll put the playlist for the taxes for those, and you can take a look at those videos. It's pretty interesting. I haven't done one on Nusi yet. Maybe I'll do one on Nusi as well. If you're interested in these types of videos, please make sure you go ahead and like and subscribe and set that bell notification so you can get future videos like this. Before we get started, I just want you to let you know I'm not a tax professional. I am not a CPA, and this is not tax advice. And with that, let's go ahead and get started. First thing we're going to look at here is Global X's website. So I do have QYLD pulled up right now, and that is one of the most popular ones. It's got a cult following, the whole 9 yards behind it. And look at that. It's got a fake Morningstar rating there. Just kidding. All right. So where would you go from here? You would click on Documents, brings you down to the bottom of the page. We want to click on Supplemental Tax Information, brings us over here. And then if we scroll down a little bit here, we have these Form 19As, which they're not official tax documents. They're just put out by Global X ETFs, in this case here, Global X, and they're the projections of what they think the income of how it's going to be taxed. But that's all you have during the year. That's your Bible, right? And in this case here, let's just pop up, this one for here for November 22nd, 2021. And what we can see is we can see the distributions. It looked like a total of 22 cents for that month. And it had as 96.65% as being return of capital, or AKA ROC, right? And then we had a net investment income. Sometimes they call that NII. That's 3.35%. So that's an issue there because all of last year for 2021, for example, this is what all their documents showed. Let's just pop another one up here. Here's April 19th. Look at that, 100% return of capital there. And I can tell you that is not how it got reported to your broker. So that's an issue, especially for the people that are deep into these funds, right? All right, so where do we go from here? I just wanted to show you these Form 19As. Those are just projections of how they think these things are going to be taxed. It's the same thing if you went to XYLD, RYLD as well. But what we're going to look at here is we're going to look at the full tax year supplemental, a supplement for all 2021 Global X distributions is available here. That just opens a document for us here. And it brings this document up here. I know it's very hard to see. Matter of fact, I'm actually going to make that a little bit bigger here. And that's what she said, of course. All right, that should be good enough because all we really care about is the stuff that was really on the left-hand side here. I have the QYLDs popped up first there, and there is all the distributions, and then there's the breakdown right there, and whether or not they paid any foreign tax or whatnot. So what we want to really see here is we want to see whether there's any short-term, and we want to see if there's dividend income. So it looks like here for looks like December, there was no dividend income, but there were short-term capital gains of 49 cents. That was a humongous payment for me. And, so it paid out a total of $2.35. You add the 49 cents to it for the short-term capital gains, you get a total of $2.85 they paid out last year. So on here, it just says dividend income. We have a little bit of short-term capital gains in there. But, how was this reported to The brokers, that's what matters, right? I don't really care what this shows. I mean, we care about what's getting reported to the actual broker. So let's pop that up next. All right, I got my Schwab document up here, and what we're looking at is the ordinary dividends, non-qualified dividends. So for me, QYLD had over $1,039.35. XYLD had $1,841.74. And we also just had a little bit of payment there that actually showed up in 2022 that counted for 2021. That's what that's telling us here. And then we scroll down here, and that's in box 1A. And then we also had some short-term capital gains, and so QYLD, $1,116.80, and then we had the YLD as $114.14. Like I said, it was a pretty darn good short-term capital gain that QYLD paid out of $1,116 is a pretty big surprise, and I was happy to get it. But I was not happy to see that all the other income was just regular ordinary income. It is not return on capital. There's zero return on capital for QYLD, XYLD, or YLD this year. So I broke those out here, how I broke out the other ones out, and here is QYLD right here. So we had ordinary dividends as $1,039.35. It was $1,039.35. That is taxed at whatever ordinary bracket you fall in. So if you're in a 30% bracket, you're going to be taxed 30% on that. And then we had that big, humongous short-term capital gains, which essentially is taxed exactly the same. The main difference, the way I understand it is you can't offset dividends with short-term capital gains and vice versa. But what you can also do is you can offset short-term capital losses with the short-term capital gains. So you cannot offset the ordinary dividends with the short-term capital gains or long-term capital gains, and that's basically the difference there. But they are taxed exactly the same there. And so whatever bracket you fall in, so for me it's like 33-35% or somewhere around there. So that hurt me pretty bad because it was zero return on capital. So we had 48% there was ordinary dividends. We had 51% there in short-term capital gains. My total income for QYLD this year, or I guess it was for 2021, was $2,156. We go to the YLD there. We had ordinary dividend income of $1,841.74. We had, that was 94% showed as ordinary income, ordinary dividend income, or non-qualified dividend income, if you want to call it that as well. And we had the short-term capital gains that are $114.14, and only about 5.8% there fell into that category. So I had a total income for XYLD as $1,955. And then we have the YLD there, which is in my, my M1 account. So that, if we scroll up to the top, let's scroll up here. Here's a better look at it. So here is the RYLD and the M1 finance. So those are the payments I received right there. Only $62.36. There's not a lot of capital in there. It's only like $2,000 or something like that. And this very last payment here was actually short-term capital gains. But what I want to kind of show you, which is kind of interesting, just as a side note, the side note that I wanted to tell you about was this right here. I was trying to figure out what the heck this was. $19.34, it says substitute payments in lieu of dividends or interest. I thought that had to do with a capital gain, but further inspection or further research, I guess is a better word, that seems to be that M1 Finance loaned my shares out, and then they paid interest on them. And that's what it seems to me. So somebody probably borrowed the shares to short RYLD, and then part of the process there is M1 gets paid interest, or they'll pay me interest for that. And we normally kind of split it. Most of the brokers split it with you. So if they pay, if the payment's like $20, they pay you 10, and then they keep 10. But that's kind of like free money. I just did not know that M1 Finance did that, and I'm pretty sure that's what that was. I cannot figure out any other reason of what that actually would be at all. So it's kind of interesting. I know some other brokers do it. E-Trade does it. Schwab does it. IB does it. So anyways, all right, moving on here. All right, so this year we had 0 return on capital, when that's kind of what these YLDs are kind of known for, right? We really wanted return of capital, and I can tell you right now, JEPI didn't, I don't remember if JEPI had any. If it did, it wasn't very much. And Devo, if they had any, it wasn't very much. I can tell you that NUSI was, I think, 100%, almost 100% return of capital this for 2021. And the YLDs here were 0% return of capital for 2021. And that's a problem, because if you have a lot of money into these funds, and now granted, so I did not have a lot of capital in any of these funds last year. I had roughly about $50,000 in QYLD, $50,000 in XYLD, and then about $2,000 into RYLD. And then I even cut those out of my portfolio before I got hit pretty bad. I was anticipating those being return of capital, so I kept them in a taxable account. And in most cases, it does not make any sense to keep these ETFs that pay return of capital, or most return of capital in your tax deferred account, because it makes sense to keep it in a taxable account, because guess what? You don't have to pay taxes on it until you sell it, right? No tax until you sell. So why would you put these funds inside a tax deferred account, right? But I'll tell you, 2021 really, I don't know, 2021 here being 0 return of capital, that would make me rethink where I put these funds. Now, I don't own QYLD or XYLD anymore, and I just have a small amount into RYLD. So I'm not really too worried about keeping RYLD in a taxable account. But what if you had a lot of capital in these, right? I know there's a lot of people out there, there's some Reddit folks and all that have a lot of capital in these. Now, I had about $4,000 of income from these or something like that. And I think I'm at around a 35% bracket this year. So that hit me about $1,300, right, in taxes that I had to pay. Just with that $4,000 right there, right? I have I think total tax bill of $75K this year. And this hit me $1,300. So $1,300 of that $75K was from just these funds, right? And I was anticipating that basically being 0. Right, so that $1,300 would have been $1,300, $1,500 less than what it ended up being. But what if I had like a large amount of my portfolio in these, right? I mean, if we go here to look at my portfolio, we scroll down here. I got NUSI with roughly about $48,000 in there. Devo $257,000, and JEPI $259,000. What if I had a large amount of capital into QYLD? And it was 0% return of capital. That's a boatload of taxes I have to come up with that I would not anticipate, right? So that is a big dilemma for these funds. I don't know if we can trust Global X at this point, because I wouldn't trust them at this point. Now, it's not going to hurt me because I'm not in these funds anymore, and I only have a small amount in RYLD. But if it was me, going forward, I would not know where to put these funds. I would have no idea which account to put it in, tax deferred or taxable account. And part of these funds are their income funds. And I know there's a lot of people that use them. That's like a big portion of their portfolio. And it could be for me too. There's other reasons why I'm not in them. But what if I had $250,000 in there, and that's what, 30 something thousand dollars or something? If you had not quite 30, but I guess about right around there, 30, right? Let's just do the math on that, right? $259,000 in there, and it pays about a 12% into QYLD. $31,000 of income, and you were anticipating 100% return of capital, so you paid 0 taxes on that $31,000, and they do a snafu like they just did this year, And guess what? You know, I mean, even if you fell in a 25% tax bracket, right? And you had a normal 9 to 5, you made like 75K or something like that. And, you know, you minus, let's say 10K for your 401K. You get a standard deduction, the whole 9 yards, blah, blah, blah. And then let's just say you had $31,000 of income into, you know, from QYLD. So you had $84,000, right? I don't know what bracket that is. That's like a 25% bracket or something like that. Obviously not the full amounts taxed at that, but let's just say you fell into a 20% bracket, right? $31,000 times the 20%. So that's $6,000 that you would not have had to expect to pay because you expected 100% return of capital. That's a big dilemma for some people. I'm going to tell you right now. For me, I don't want to deal with that, right? My big concern right now is to reduce my tax liability significantly. This is my worst tax bill ever, $75K. And so going forward, I only have 16 days left until my last day of work. So for 2022 going forward, I need to have a predictable tax bill. And I can get that out of JEPI. I can get that out of Devo. I can get that out of NUSI until something changes where any one of those funds basically screw me like QYLD or XYLD did. Then, you know, I make a decision then, right? I can always dump NUSI. I don't need to be in NUSI, right? So that was 100% return of capital this year. Devo and JEPI are more tax favorable, in my opinion, than QYLD, XYLD, RYLD were this year, or excuse me, 2021 tax season. These actually are pretty tax favorable, in my opinion. Yeah, you're taxed. You know, there's short term, there's qualified dividends, there's unqualified dividends. I think there's a little return of capital there. Yeah, you're going to pay a little bit of everything, a little bit of a mix of everything there. Make sure you take a look at that video on those because I already did a tax video on those. But that's okay. That is more predictable, right? If you expect something to be a 100% return of capital, like these funds here, according to their 19A, that's what I'm kind of expecting, or at least somewhat close to it, right? 75% would have been better, right? Don't freaking lie to us, QYLD, XYLD, or Global X, right? So that's just my thoughts on it. I cannot trust what those funds are going to do, so I don't own them anymore. And would I ever own them in, you know, down the line? Yeah, I probably could down the line. You know, if I was on my deathbed or something like that, maybe I would own them again. But for me, I just don't need them. I want to have more predictable taxes going forward. And guess what? The Global X ETFs, QYLD, XYLD, RYLD are not those. They just do not provide any predictability in the taxes, right? You know, this year, if it's 100% return of capital, then so be it. But what's going to be in 2023, right? What about 2024? And if they keep moving back and forth, that's a problem. It's just not something that I can deal with. For some people that don't have a lot of income from these funds, it's not probably a big deal for them. But for the folks out there that invest heavily in these are a big deal for those folks. I can tell you that right now. So I hope you got something out of this video. Leave me a comment down below and let me know your thoughts. Love to hear them. Until next time, we'll see you next video. Thanks for watching.